Okay, I'm going to come around and look at your pre-test, memos, resumes. I'm going to take a look at all everybody's presented.
All right, so we did chapter 1, so just background on investments, sort of additional terms in chapter.
Okay, can you speak up, please?
So 1.1 was sort of just again the definition. So the nature of investment is essentially to reduce the current consumption for greater future consumption. So basically giving up what you have now to benefit in the future. And then there's the idea of real versus financial assets, which real assets produce the goods and services in the firm or just in any business, such as property, plants, equipment, human capital. Some financial assets are the claims on these real assets. They sort of give, they're sort of the intermediary between transactions. So in the end, all financial assets are offset by this financial liability between two parties. And the net wealth of the economy is the sum of these real assets. So in part 2, we have the idea of fixed income securities, which are money market instruments such as bank certificates of deposit, which is essentially giving some money to the bank with a promissory note not to touch it. A T-bill is sort of the same thing, but with the treasury. And then there's commercial paper, which is sort of short-term lending for corporate businesses and their ventures. And other securities are, of course, bonds, preferred stock, common stock, and then derivative securities, which the professor talked about last week, sort of that's some of the underlying market condition. And then 1.3 sort of talk about the role of financial markets in the economy, but sort of how these markets have different tendencies. So like the questions that came up were, do current market prices represent the fair value estimate of the security's expected future risk and cash flows? And as we know, that is not true. And then the last thing, the pretty big one, was consumption timing, sort of what makes you money in finance, I guess, for just the individual investor, and sort of the balance of spending and saving, theoretical optimal overall standard of living throughout your stages of life. So basically when to invest or take out for work, for starting your family, retirement, etc. And it's better in the short term, but consumption timing isn't always predictable, so in the long run, you might not know whether investing right now would be of your benefit. And the last thing was risk comparison. So investors can use risk as a determining factor for allocating capital. Of course, there's a bunch of ratios and different analytics that finance people go through each and every day, I guess. So yeah, you use risk comparison to sort of compare all sorts of securities and sort of calculate your own trade-offs. You have to be either aggressive or conservative with your risk comparison. And then the last topic was investor trust. And from this, the biggest sort of legislation that came up from sort of the Enron age was Sarbanes-Oxley Act 2002, sort of get rid of fraudulent behavior and sort of have the government intervene with systemic risks. So the governance and ethics failures in business are pretty costly because loss of trust in the system is less. The investors are less willing to allocate their capital to the market and are more likely to save in the banks.
Because you're learning.
Yeah, I just brought up the importance of auditing.
choice of particular security portfolio in each asset classes. And usually the percentage of fund in asset class will be like 60% of stock and 60% of bonds and 6% of alternative assets and 4% of money market securities. And the financial market is highly competitive, so there is no free lunch position which has several. So indications. The first one is the risk-return trade-off. Risk-return trade-off is higher expected return has higher risk, and we can use diversification to decrease the risk. For example, like the bond, it has a lower average rate of return, which is under 60%. So it has not lost more than 60% of their value in any 1 year. The second one is efficient market hypothesis. This hypothesis states the financial market process all available information about security quickly and efficiently. So security should not be neither underpriced nor overpriced on average, and the security price should reflect all information available to the investor. And the choice of appropriate investment management style based on belief in market efficiency. So there are two types of investment management strategy. One is active management, which is when the investor doesn't believe the efficient market, so they will finding undervalued securities and by timing the performance of both assets class, for example, increase one commitment to stop when one is bullish on the stock market. For the passive management strategy, which is when the investor believes in the efficient market, so they are called for holding highly diversified portfolio without spending effort or other resources, attention to improve investment performance through security analysis. Holding a diversified portfolio such as investing and constructing efficient portfolio.
In the financial markets, there are three major types of players. Debt borrowers, which means after spending, you will be borrowing money, and net savers, such as households, they will end up saving more money on average. And financial intermediaries, they are the middleman between borrowers and savers. They bring them together. The governments are both borrowers and savers, depending on the time. Most business firms, they have to borrow money. They rely on using debt to finance a lot of their projects and to just keep their day-to-day operation going. Financial intermediaries, the middleman of the financial markets, include financial banks, management, investment companies, insurance companies, they are a big player as well. Pension funds and hedge funds. And also investment bankers. That was part of the last slide. The market is divided into two parts. The primary market that us as households we don't usually see. The primary market is for investment bankers that underwrites the issuing of new stocks, newly issued securities. But most of us will be in the secondary market. That is the sale and purchases of existing stocks already. The financial crisis of 2008 is a recent event that is very impactful to our economies, and we are recovering from that. It started with what is called a mortgage derivatives. It's a CDO, collateralized debt obligation. It consolidates loans into, think of it as packing loans into a financial product. And then payments are divided. There are rating agencies like AAA, AA, triple B, those ratings. Back then it's kind of a corrupt system, and they were paid by the issuers to give them higher ratings for these debt obligations. And then also, credit default swipe was a problem as well. These are insurance contracts against borrowers defaulting out of their loans. Because of these contracts, risk were driven up a lot. And for example, AGI sold credit default swap contracts for over $400 billion. That is a lot of systematic risk. There was a diagram. Systematic risk is the unavoidable risk in a market. So with diversification in the stocks, you can eliminate unsystematic risk. But systematic risk is known as the market risk, and you cannot avoid it. It's the market risk. So if market does crash or something happens in the overall big picture, this is the risk you'll be facing. But when it actually happened in September 7, 2008, Fannie Mae and Freddie Mac, these are government-backed banks. They were lending out a lot of housing loans for a lot of times, no down payment, and doesn't check your credit, and they don't care about your income. So these two companies, they were put into conservatorship, and then Lehman Brothers and Merrill Lynch, they would follow. Based on time, they had trouble. They went into almost bankruptcy after Fannie Mae and Freddie Mac, and just 10 days after, the government had to step in order to prevent a big crash from happening. They bailed out some companies and banks. They lent $85 billion to AGI. And after that, the government weren't able to intervene in a big scale, so the money market went into a panic. And as we know, when the financial market drops below 1,000 points, it freezes the financial market. The government had to respond to the financial crisis. So there were requests for stricter rules regarding bank capital, liquidity, and risk management. the new laws that were put into place, they mandated more transparency in the companies, financial reports, and management. And the regulation system and the laws were more clarified after the crash. Volcker's rule is limiting banks' ability to trade for its own accounts.
Yeah, the homework problem from the book sort of went over just the different financial assets and whether these financial assets were created, destroyed, or destroyed in different scenarios. So for the scenario A, many firm takes out a bank loan, receives $50,000 in cash and signs a note promising to pay back the loan within years. Basically, the answer was the loan was the financial liability for the borrower and a financial asset to the bank. Cash that was received by Lanny is a financial asset, and the new financial asset is then created. Scenario B, Lanny uses the cash from the bank plus $20,000 of its own funds to finance the development of new financial planning software. So basically, Lanny had transferred a financial asset to the software company in exchange for basically a new real asset, and the financial asset which either created or destroyed. In scenario C, Lanny sells the software product to Microsoft, which will market it to the public under the Microsoft name. And Lanny accepts payment in the form of 1,500 shares of that Microsoft stock. So in this scenario, Lanny exchanges the real asset, which is the software, to Microsoft in exchange for a stake or a financial asset. And if these shares were newly issued, it would be a creation of a financial asset for Lanny. And then the last scenario was essentially Lanny selling the shares of stock at 80 and sort of using the proceeds to pay off the loan that scenario A was talking about. So because Lanny sold his financial asset of the stock for another in cash, the sum of $120,000, it paid off another one of his financial assets, and essentially the first financial asset of Lanny's financial assets was essentially destroyed.
I got the same. Like you gotta show it for here. You don't hear it. It's just for
is basically talking about asset classes and so we don't have to. So first of all, asset classes, there are three types. One is fixed income, second is equity, and third is derivative. So for the fixed income type, first of all is so first of all, the money market, so the characteristics is that first of all, they're short-term, high liquidity, low risk, and they often have to be larger denomination. And then, so now we come to money market securities. So first of all, we got treasury bills. We can call it as T-bills, which is basically the short-term debt of risk. And then we got certificates of deposit, we call it CD, which is basically time deposit to the bank. And then commercial paper, which is the short-term unsecured debt of a company. And then we also got next up, which is bankers' acceptances. Well,
Can you speak up? We can't hear. And people are talking, so it's really hard for me to hear.
Okay, so for the bankers' acceptances, well, I see it as a future option that is from bank instead of from company. But the definition is that it's an order to a bank by a bank's customer to pay a sum of money on pay. And then we also got real dollars, basically pretty straightforward. It's dollar denominated time deposits in banks in the US. And then repos and repurchases. We wonder what repurchase is, which is basically repurchases. So the definition of it is which is a short-term loan backed by. And then lastly, we got federal funds, which is basically a very short-term loan between banks. And remember, it's between banks only. And then for use on money market instruments, again, so basically the money market is you're basically investing, so therefore there's always a risk while you're investing in money market securities. And also that premium on bank CDs, the certificate of deposit, the T-bills, treasury bills spread have often become greater during the periods of financial crisis. And here's the example. So as you can see, during the 2008 financial crisis, you can see the certificate of deposit and treasury bill rates jumped really high. For part of the reason is that the Dutch government offered insurance to the money market mutual funds after the same funds experienced losses.
So a capital market is a financial market in which long-term debt and equity-backed securities are bought and sold. The most common capital markets are the stock market and the bond market. Usually, the bond markets are also called capital markets. So, they're liquid and they're low risk, but not as low as the money market. The bond market is a financial market where the participants can issue new debt. sell debt securities, that is the secondary market. The U.S. government mainly borrows funds by selling treasury notes and treasury bonds. T-notes, treasury notes, are issued with a maturity up to 10 years, and T-bonds are issued with a maturity ranging from 10 to 30 years. Both of them make semi-annual interest payments called coupon payments. Municipal bonds are bonds that are issued by state and local governments. And like treasury bonds, municipal bonds are issued with maturity ranging up to 30 years. The key feature of municipal bonds is their tax-exempt status, because investors don't have to pay federal or state taxes on the interest proceeds. They are willing to accept lower yields. There are two types of municipal bonds: general obligation bonds, backed by taxing power of the issuer, and revenue bonds, backed by project's revenue. An investor choosing between taxable and tax-exempt bonds should compare the after-tax returns on each bond. If you look at this, you know that if the before-tax return on the taxable bond times 1 minus the investor's marginal tax bracket is more than the municipal bond rate, then taxable bond gives a higher return, or else the municipal bond is preferred. As you can see in this diagram, the higher the tax bracket, the more valuable the tax acceptance order of municipals. That's the higher. Corporate bonds are bonds issued by private firms. Like treasury bonds, corporate bonds also make semi-annual interest payments, but have a larger default risk. So not all corporate bonds come with the options. Some do though. Some come with options, and these are the options. Callable, the firm can repurchase the bond at a stipulated price, and convertible, the bondholder can convert the bonds to a stipulated number of shares. A mortgage-backed security is either an ownership claim in a pool of mortgages, or an obligation that is secured by such a pool, and is produced by securitizing mortgages. So, in the years leading up to the financial crisis, private label issuers securitized large amounts of subprime mortgages. Subprime mortgages mean riskier loans made to financially weak borrowers. So, I was actually going to talk about the financial crisis, but the first team already did that, so I'm going to skip through that, and I'm just going to show you how this is the explosive growth of mortgage-backed securities until the crisis. And after that, you can see the black one, the private issuers, started to rapidly shrink down because of the trillion-dollar debt this explosive growth caused US to have.
And for equity, we have common stock, preferred stock, and ADRs. Common stock, it represents the ownership of the shareholders, the ownership of the corporation, and the shareholders have the representation of the assets, as well as have the listed rights of the loan. And for the preferred stock, it's and the dividend were like the interest for bonds. However, their tax determined usually lower than the normal income.
Okay, so you go back.
And the ADR stands for American Depository Receipt. It's basically the certificate traded in the U.S. market that represents the ownership in shares of the foreign company. Through the stock market index, investors can buy index mutual fund or exchange traded funds. short position is significant. Here is the comparison between the option and future contracts. One of the most important differentiation is option is a right but not obligation, while the futures contract is obligated to make or take delivery. And others would be like the option, the premium is the price of the option itself. But for the futures contract, the are entered into without option.
Are you done? I didn't hear any clapping. Who's next?
Mike, team
Do we have anybody else?
Team two.
Is that it?
I'll review the team.
Chapter 1. Yes, 7.
I like our team is there.
7. Does that just mean number 7?
Next Tuesday, I'll walk you through some of the other Excel spreadsheets you can use that you have some exposure to.
That's kind of good.
Oh, about the worksheet? Yeah, I want to go through those. And you guys can start working this. But let me walk you through it first. So I'm trying to get basically just the foundational stuff done. And then we'll just be doing most of the class. All right, so let's go back to the pretest. Okay. Any questions on the pretest? How do you test question? How do you determine the dependent variable that you're trying to forecast? How would you come up with it? Yeah. I asked you in the pretest, I asked you how do you determine the dependent variable? Well, they're going to tell you, aren't they? We need to forecast return on equity. We need to forecast, earnings. We need to forecast profitability. We need to forecast sales. Based on business and based on the industry that you're in, there's a set standard of metrics that you're going to be trying to forecast. Okay, and it's based on business and finance. How do you determine the independent variables? How would you determine the independent variable? You guys need to be engaged in this process. Because do you think that your clients, the senior level executives, the investment committee, the board of directors are going to be asking you questions? Yeah, they are. And they're going to be drilling you. Question after question after question until they're satisfied. That's all you do is answer questions. Okay? If you can't answer the questions, what do you say?
I don't know right now, but I'll get back to you.
I don't know right now, but I'll get back to you. What do you need to know? Okay. You don't make something up, you don't lie, you don't do any of that stuff. You just tell me about that. Okay? Because they'll catch you. So how do you determine the independent variables?
The variables that influence your why you do something.
Yeah, but let's say you've never, I think we all went over this already. Somebody comes up to you and says, we need to build a ROE, return on equity model. Can you do it?
Yes.
You've never done it before? What's your answer?
I'll get back to you.
No?
Yes.
No, the answer is yes. But I've never done it before. How would you do it? You turn it around onto them, and you say, how would you do it? Can you help me out? Or is there somebody else here that could do it, that could help me out? So it's not that you can't do it because you've never done it, you can totally figure it out. You're not, basically doing, aerospace engineering, that's really hard to do. Intercontinental ballistic missile stuff is really hard. Finance is not as hard, okay? So we're not talking about, quantum physics or anything like that. We're just talking about, basic mathematics in most cases. So the answer has got to be yes. What's the second question that comes out of your mouth?
How would you do it?
When do you need it? What else?
When?
Yeah, when do you need it? What else?
What else do I need to consider?
Yeah, what else do I look? Do we have any data? Do we have anybody else? Has any of these models been built before? What variables do you think should be in the model? I turn the thing around and I start asking all these questions. Because I'm trying to use inductive and deductive reasoning to give myself enough information for me to get started on the project. And then I'm going to read a bunch of articles, I'm going to talk to a bunch of people, I'm going to collect the data, I'm going to test the model, I'm going to refine the model, and then once I get the model where I want it, I'm going to back test the model. And if it looks like the model is going to do a good job of predicting the future, I'm going to basically do a pilot. I'm going to start tracking it in real time. Maybe see if I can forecast ROE next quarter, or next week, or next day, whatever it is. Start back testing the model to see if I can minimize the mean squared error and some of the other terms. And then once I feel confident that the model is predicting and is doing a good job, then I'm gonna full blown do the model, make the forecast, put it into a PowerPoint presentation, present it to the investment committee, make the recommendation, and if I'm right, in retrospect, I'm gonna get bonuses and salary increases, promotions and so on.
How long do you think that process could or should take?
It took me, when the executive, the CEO of the multi-billion-dollar REIT came to me and said, we need to build a portfolio strategy for the firm. We don't have one. Our acquisitions and developers are basically going out and buying and building properties with no strategy. It took us a year. It took us a year to do the research, to build the models, and I'll actually show you what we did in this class. So you can see exactly what we did and the thought process and the actual outcome, the actual product. Not only the report, but also the PowerPoint presentation. It took a year to build the model, and then it took the firm 3 years to get to the target allocation. So it's 4 years. And then they spent another 3 years after that going out on the capital allocation line, jumping off the efficient frontier and levering up the portfolio and taking on more risk. So, and then the company got bought at some point. But it took a long time because we were in real estate. In stocks and bonds, we could have come up with a multi-billion-dollar, portfolio allocation, and probably could have fully funded it, $2 to $4 billion in probably, 2 to 4 weeks, 2 to 4 months,
So
as opposed to 2 to 4 years.
so real estate is that much more?
Yeah, it's lumpy, it's asymmetric information, a lot of information costs. I can't buy, $4 billion worth of real estate. That would usually take me about 5 to 6 years.
Yeah.
I could probably buy a $1 or $2 billion of real estate investment trust securities because the market's at about $1 trillion now. We couldn't do it when I started in the industry in 1996 because the market was only like 40 billion. And now it's $1 trillion. Yeah, there was major illiquidity issues back then. Okay, so those are some examples. Any, what else? Internal validity, you're going to get it from people inside the firm. You're going to have to get by people inside. That's why you co-opt them and you make them stakeholders and you make them part of the research process. Because you don't want to have people that are questioning your methodology and blowing you out in front of the board of directors. You want all that stuff done, before.
Ahead of time.
Yeah. Yeah.
A question about that, because I did some research to find out the answer was to that question, and online it said that internal validity is when your conclusion works within your study, but then external when it works outside of your study.
Yeah, so internal is inside the firm. So it's internal to the firm. And then external is your checking to see if your results are similar to the results that have been conducted before in the peer review journal articles in industry. So it's external validation. So when you're in front of the committee, they're gonna say, well, how did you build the model? And well, the first thing we did was we interviewed all the experts within the firm, and we interviewed experts outside the firm under a non-disclosure agreements, okay? Because we didn't want to give away our IP. And then we basically read industry research reports and academic research reports, and found the models and the variables that came up over and over again in the literature that then created theory, because the results were consistent over time using different data sets over time. And then when I'm defending myself, in the meeting, I'm basically citing those research reports, the authors, when they were conducted, and I'm also citing the journals. So I'm basically defending myself. And then if I can adhere to theory, defend myself, show them that it was extremely thorough in my approach and everything was reasonable, they have no problem with it. They bought off on it, and you're done. Okay? And then they'll basically say, do it again. Go do something else again. Either different, or go do the same thing, but in a different way. Now you can do it really fast.
Were you giving those authors and stuff credit just throughout
Absolutely.
the flow of it, or at the
Totally.
end you said, this guy said?
No, during it they'll say, like, why did you use that variable? Well, we used that variable because it came up over and over again in these 3 articles within these journals by these authors at this time period.
Yeah, that makes sense.
Yeah, so you're just constantly defending yourself. And I'm working on a project now that's like that. I'll be probably in front of some pension fund advisors or some consultants. These will all be Ivy League, MBA, PhD types, and they'll just be grilling me. And I'll be saying, this is what we did, this is what we did, this is what we did. This is the PhD guy we worked with. We have 2 PhDs, I'm a PhD. We have these data analysts, we have this technology firm. We have these other people that we're working with PhDs, master's degrees in data science and finance. In economics, you're constantly just defending yourself.
Yeah.
Because you don't want to be blown out. Okay. So let's go back to page 13 and let's start working through this stuff real quick. I know some of you have already started working on it, which is awesome, but I want to move through this stuff pretty quickly so we can get on to the application. So how much time do I have?
40
How much?
minutes.
40? Oh, cool. All right. So here's the key. You can't really study finance unless you study economics. And you can't study finance unless you study monetary policy and macroeconomic theory. Because basically, macroeconomic theory and monetary policy, basically conducted through the Federal Reserve, has a direct systematic impact on the value of securities, of investments. Real estate values, stock values, bond values, commodity values, derivative values, it all flows down from the top. I don't think the books in 305, I don't think the books in 330, you guys don't take a financial institutions class. And you probably took macro economics, and you probably had a little bit of monetary policy, and you probably forgot most of that stuff. Okay. The problem is that up until the financial crisis, monetary policy was relatively straightforward. It actually worked really well. And then the financial crisis hit, which was the mother of all financial crises. And the Federal Reserve and the central banks across the world had to start conducting unorthodox monetary policy that basically turned finance on its head. Okay? And we're living with the consequences today. So it's beautiful and great to be able to read these books, and the theory's nice and elegant, and the proofs are beautiful. But when you start applying that stuff to the real world and what the real world is actually doing, the models could blow up in some cases. And the models need to be modified under the context of reality. Okay? And that's kind of my thing. There's usually 2 types of professors. There's industry people with academic backgrounds, and then there's academic professors with theoretical backgrounds. They're both legit, but there's 2 different approaches. There is overlap in the content, but us people in the that come from the real world are really using those models, stress testing them, seeing where they work and seeing where they blow up, and see if we can modify them to make them work again. And if we can't make them work again, we have to invent new models, or modify them, or augment them to get them to work. Okay. So unorthodox monetary policy, quantitative easing and negative interest rates, and I'll show you some examples of that. has basically changed finance forever. Okay, so we have to understand it. The first place to start with this stuff is the size of the Federal Reserve's balance sheet. Okay, and you can look that up. You can go up to the Federal Reserve Board of Governors, which is out of New York. Monetary policy, particularly open market operations, are conducted through the Federal Reserve Bank of New York. Okay, they have basically a monopoly on trading Treasury securities and using the monetary policy tool of open market operations to basically buy and sell sovereign bonds in the open market to basically drive up and drive down bond prices, drive up and down interest rates to either cool or stimulate the economy. Okay, and that's the number one tool. You can use reserve requirements, and you can use, open discount rate windows, and you can use federal funds rates also as monetary policy tools too. But open market operations are the most used and the most effective. So the size of the Federal Reserve balance sheet, prior, if you look at any of the graphs that show the reserves or the assets, obviously assets have to equal liabilities. So if you look at the balance sheet, you look at the amount of reserves that banks hold at the Federal Reserve. Historically, if you go back post-World War II, maybe the modern era of monetary policy started in 1970, by basically deregulating the bond market and deregulating the interest rates. Because we moved from pegging interest rates to pegging money supply growth rate. So when we moved from pegging interest rates to pegging money supply growth rates, when we peg money supply growth rates, we allow interest rates to move, to go up and down based on supply and demand in the marketplace. That was a big deal, because in 1970, when we moved from targeting interest rates to targeting the money supply growth rate, you need to understand this. What happened was interest rates became volatile, and there was all kinds of interest rate risk that banks were trying to manage. And Wall Street invented forward contracts and futures contracts, and options on futures contracts, and swap contracts, and swaption contracts, and CDOs, and credit default swaps to be able to manage the interest rate risk and the credit default risk. Okay, so Wall Street basically came and invented these securities to basically meet the needs of the institutional clients, both multinational corporations and financial institutions. Okay, so the size of the Fed's balance sheet was around $250 to $500 billion for like 30 years. And that's all the Fed did, was have an inventory of bonds that they basically either sold or bought in the open market. If they wanted to cool the economy, they'd sell off the bonds, bond prices would go down, interest rates would go up, the cost of capital would go up, the businesses and people would consume and invest less, and it would cool the economy. If the Fed wanted to stimulate the economy, they would start buying bonds that would drive up drive up bond prices, drive down interest rates, drive down the cost of capital. More people would borrow to consume and invest, and that would stimulate the economy. And the Fed was actually really good at basically using open market operations to basically manage the economy, to basically allow the economy to experience mild recessions basically every 10 years, to wring out inflation expectations, to keep the dollar relatively low on a purchasing price parity basis on a global basis, because if the dollar is relatively low, then our exports are cheaper on a global basis. People are going to buy more of our goods, we're going to export more, and that's going to lead to higher GDP and higher wealth and higher stock prices and those things. Okay, so the size of the Fed's balance sheet was between $250 and $500 billion. In the financial crisis at the end of 2007, and right after Lehman blew up, the stock market was careening and crashing. People were going into gold, and the banks were basically insolvent, okay, at that time. So Citigroup bank had to be nationalized, AIG had to be nationalized, even though they don't call it nationalization, but they basically were. The Fed and the Treasury basically stepped in, swapped off the bad securities on the asset side of the bank's balance sheets, gave them Treasury securities. The Treasury basically gave the banks, the banks basically sold the Treasury, convertible preferred stock, which counted as equity to shore up the equity portion of the balance sheet to keep the bank solvent. Because if the banks basically went insolvent, there would be runs on the bank, people would panic, and would go into a depression. Okay. So the Fed basically printed up until about 2017, 2016 was the peak in the Fed's balance sheet. Okay, they were printing all this money. The Treasury was issuing all these bonds to do deficit financing. The Fed was the market maker. They basically took all that printed money and bought the Treasury's bonds and moved those bonds, that debt, onto the Fed's balance sheet, not onto your balance sheet. So they basically publicized the sovereign debt. It's kind of a messed up situation, actually. And the Fed's balance sheet went from 250, 500 billion to peaked out at 5.3 trillion, and is currently at about 4.3 trillion. Okay. So we've never been here before. The line looked like this, and then it went like this. So we don't know what this means. Can we do it again? Can we go into another sovereign, it's not going to be a banking crisis next time, it's going to be a sovereign bond crisis, okay? Where a lot of emerging market sovereign debt is going to go into default. And a lot of that debt's on the bank balance sheets. Okay, so what's the Fed going to do? Are the central banks going to print? We have 4.3 trillion, okay, that we printed. There's about 35, 40 trillion on a global basis because everybody else followed what the Federal Reserve was doing. And we found out that the Federal Reserve was actually buying government bonds, foreign government bonds, to save their system too. So we became the central bank of central banks. Okay? And now all central banks and economies are now coordinated through our central bank as central bank. Okay? So it's completely, the system has changed significantly.
Is this because it is the major reserve currency of the world?
One is we are the major, and plus we printed a lot of money, and we are the reserve. And we're the anchor economy on a global basis. We're the dominant economy.
Like, what do you like? I mean, I don't know. Like, how does the Fed know that we need to print this much, and why can't we not like?
They have really smart people there. I mean, their policymakers basically went to Paulson and went to Geithner and basically said we're going to need to print about $5 trillion to bail out the system. And what they did was they bought not only commercial paper that was defaulting, they bought CEOs, they bought swap contracts, they bought forward. They basically bought all the junk off of the bank balance sheets and threw it onto the Fed's balance sheets. They cleaned up the bank's balance sheets, and then the Fed has spent the last 10 years basically unwinding a lot of those positions, and then ending up with a balance sheet of 4.3 trillion, which is a lot. Can they do it again? We don't know. Maybe not. So we basically shot all of our bullets on the last financial crisis. And most of the countries too are at their debt limits in regards to fiscal policy. So we're kind of getting to the end of effective monetary and fiscal policy. So the next financial crisis will be interesting to watch and see if we can actually have tools. But the Fed thinks that they can do it.
Can they print more money again?
Theoretically, they could, but we've never done it before. We don't know what the consequences are of printing this money. Theoretically, it should have been inflationary, but it wasn't. It's actually been deflationary.
Why?
Because what's happening is there's all this debt out there that needs to be serviced. Corporations, individuals, and governments have loaded up on all this debt, and the money that they could be using to spend on infrastructure, consumption, investment is now going to service the debt first. So all that money that otherwise would be going into productive investments is being crowded out by sovereign debt payments. Okay. All right? So I don't want to get too hung up on this. Okay. So that's the size of the balance sheet. This is unorthodox monetary policy. You have to understand this. How much money by banks are being held on reserve at the Federal Reserve? Basically 4.3 trillion. The size of the balance sheet and the reserves are actually really close to each other, so they're basically the same. What was it prior to 2007? Between 250 and 500 billion. What was it? Now it's about 4.3 to peak at 5.3. what has been the growth in the money supply since 2007? As the Fed hit gross domestic product, employment, unemployment, and inflation or consumer price index targets. You hear about it all the time. We're trying to hit these targets. They're not hitting the targets. Why aren't they hitting the targets? Okay. So I racked my brain for a while because I couldn't figure out during the recovery periods up until the last 2 years why the Fed is not hitting its 2% inflation targets and its 2% GDP targets, or 3% GDP. So I racked my brain and I basically said, the solution, can you please not talk unless you're talking about this? Excuse me? Hello? Hello? Could you please not talk to each other? Because it's distracting, okay? And you guys should be taking notes. So the solution is in the quantity theory of money, okay? Irving Fisher invented the equation, the identity, like, 80, 90 years ago. It's also called the theory of exchange, okay? And the equation basically says that the identity is that real GDP times the inflation rate is related to or equal to the velocity of money times the money supply growth rate, okay? This is the solution. And we're trying to figure out why GDP has been growing below 3%, which is the long run GDP potential. So what we're trying to do is to get the economy to grow either at or above 3%. Okay? And the Fed hasn't been able to do that until recently. And they haven't been able to hit their inflation targets either. Okay? So the question is why? Okay? So GDP was revised today for the second quarter on an annual basis. Came out 2%. They're targeting 3 to 4%. Is the Fed hitting their target? No. The inflation rate, they're trying to hit 2 to 3% on the inflation rate. It's basically running at about 1.7, 1.5. Is the Fed hitting its inflation target? No. Okay. The Federal Reserve, V is the velocity of money. The velocity of money is the number of times cash and currency in the economy cycles through the economy. Okay? And the velocity of money can be measured either using M1 or M2. M1 is actual coin currency, paper money in the economy, and M2 also includes near cash. So money invested in money market mutual funds and other short-term liquid instruments that are easily accessible as liquidity or as cash. Times the money supply growth rate. Okay? So when the Fed prints money and buys bonds, it's basically injecting liquidity and money into the system. Okay? So let's go through, because we're trying to solve for this, right? These two. Right? We're trying to solve for these two. So if I hold inflation and the velocity of money constant, I can increase GDP by printing more money. Or if the money supply growth rate goes down, GDP is going to go down. Okay? I can also hold this constant, and I can also reinflate the economy by growing the money supply very rapidly. Okay? So here's where the problem came in. The Fed was trying to push these up, right? By growing the money supply at a very rapid rate. But the problem was that the velocity of money was collapsing while they were growing the money supply, so it basically negated the influence. So the velocity of money has collapsed to historical lows. It's actually broken through its 1957 support. It's never been this low before, and it's been the case on a global basis. Part of it has to do with debt, labor productivity, collapse in labor participation rates, collapse in real wage growth. The number one variable that's highly correlated to velocity is employment. Okay. And basically the Fed doesn't do labor policy, Congress does. And Congress doesn't do labor policy either. So there's no way that they're going to fix velocity because they're not going to touch labor policy. Because they hate labor, they hate unions.
job is it?
Oh, it's Congress.
But they don't do it.
They're not going to do it. They won't do it.
It's
What?
for sure.
There for,
No, this debate's been going on for like 500-700 years. You know, you have basically Marx and communism, labor, you know, the proletariats rising up, and then you have capitalists, which are basically banks, you know, and other financial institutions. They have all the power. They have all the money. They can lobby Congress. They can lobby and put policies together. Unions don't have as much power as they used to before, so they basically have no policy input. So labor policy is off the table, and you've basically seen labor market failure. Okay, so it's a political problem. But here's the deal: the velocity of money has collapsed from nine times to 5 times. So as this was careening, they were increasing the money supply growth to try to get inflation and GDP to go, and it wouldn't work. Okay, because this was collapsing. The money supply growth rate in 2008 through 2010, the Fed was printing money and growing the money supply between 30 and 40% per year, which is extremely high. Currently, the money supply growth rate has collapsed to 5 to 8%, which is another reason why we're not hitting the targets, because velocity has collapsed. And now the money supply growth rate is starting to fall significantly, and we're now starting to see disinflation, deflation, and also lower GDP growth rates, particularly on a global basis. Okay, yes?
So what's the target velocity that they want to hit? And
They're not targeting velocity, that's my point. They're not targeting velocity.
But like, what is the ideal velocity they want?
Oh, you want to get it up to like 9 times.
Back to 9.
Yeah,
10,
it's a pro-cyclical. So if you look at velocity, it goes like this. So these are the recessions, okay? And it moved and it peaked like in 2007. And then basically it's collapsed beyond and below, and it's now starting to tick up a little bit. But it's now below, you know, 1958, you can even go back to 1947. Okay, so it's well below. And a lot of it's because of shadow banking, you know, because we printed a lot of money, and the money goes, you know, out into the global world. So it doesn't stay inside the economy to create an accelerator multiplier effect, because markets are open.
So that was kind of useless in a way, because the money, they didn't keep.
Well, they had to do it. They had to do it. They had to do it.
Yeah.
But yeah, it was policy ineffectiveness. It really, they spent a lot of money with not that much impact, basically. Because the elasticity, you know, of interest rates to stimulate the economy is a lot lower now than it was before, and tax cuts aren't really an effective way to stimulate the economy either. It just redistributes wealth. Okay. Yes. Last question.
Yeah, is this like the QTM equation?
This is QTM. Quantity theory money is real GDP times inflation equals the velocity of money times the money supply growth rate. So if the money supply growth rate is slowing, what's that going to have? What effect will that have on inflation and GDP? Probably going to go down. That's why Trump is really mad at Jerome Powell, is because he wants him to stimulate the economy by lowering interest rates to get the economy growing, so that if we hit the targets before the presidential election, if we go into a slow economy or a recession prior to the presidential election, he may not get reelected. That's why he's forcing the Fed and trying to get the Fed to lower interest rates. Okay. So the next question is if we fall into a recession, would the Fed use negative interest rate policy? There's about $16 trillion right now in negative yielding bonds on a global basis. Janet Yellen, basically before she left office, told the banks they need to do a stress test under a negative interest rate regime, okay, and see what the balance sheets, how they would hold up. So she basically was signaling the market years ago that we could be going to a negative interest rate policy in the next recession, because interest rates are already low. And they're already negative in Europe and in Japan, okay, and other parts of the world. So what is the answer? Yes. Okay. The question then becomes, what will the negative interest rate impacts be on the economy? Well, first, if the Fed becomes over accommodative, starts buying bonds, driving up bond prices, and driving down interest rates will be a wealth effect for bondholders, and the cost of capital, the weighted average cost of capital and the cost of the equity will go down, okay? Because the risk-free rates will be negative. Pull down the discount rates, pull down the expected returns, and if you just use a very simple perpetuity model to get to a valuation on, real estate, perpetuity bonds, or, perpetuity stock, as the rates start to turn negative, it pulls down the expected returns and inflates asset values on your balance sheet, and inflates bond values on the bank's balance sheets, and basically props up the system from going bankrupt or insolvent. Okay, so that would be the impact on the economy, and eventually negative interest rates would have some kind of disincentive in the long run, because there would be a feedback loop. If I'm getting negative interest rates, I'm basically paying the government to buy the bonds. So I'm not getting any coupon interest, okay? I would have taken that coupon interest if I had positive interest rates and used it to consume and invest. But if I'm getting negative interest rates, I don't have any interest income to reinvest, to consume or invest. So eventually it'll come back as a negative feedback loop in the medium and the long term. What would be the impact on asset prices? It would inflate asset prices. It would prop them up.
I don't get it. How would it inflate negative interest rate?
Okay, let's do the equation. What's the capital asset pricing rate?
So risk-free rate plus
Risk-free rate,
beta times
what's the beta,
market rate.
return on the market minus the risk-free
Risk-free
rate.
rate.
Got it, okay. And this is your expected return right here. Okay, so if this goes negative, what happens to your expected return?
So lowering.
Goes down. If this goes down, what is the value of your real estate, your bonds, and your stock?
Goes up.
Take a look. Okay, that's their objective. The problem is that not everybody owns stocks, bonds, and real estate. Basically, what the top 90th percentile of the income distribution, the top 70th percentile of the income distribution actually holds those real and financial assets. The other 70% do not own any of that stuff. Okay, so the wealth effect, the trickle down, the supply side theory is that, well, the rich people will just consume more, and there'll be a multiplier effect, and they'll bring up all boats. We know that's not the case, because the income distribution is more severe now than it's ever been before, and basically the over-accommodative monetary policy has inflated and created asset price bubbles that basically has ripped apart the socio-demographic structure of the United States on a global basis. The rich are richer and the poor are poorer. Before it was there was more of a middle class. Now you have extremes, okay, more than ever before. Okay.
So on this that example, you're saying the bond price will go up, but the equity market will perform bad. Because the cost of equity, like
The cost of equity, the cost of capital would go down, which would inflate the stock prices. The cost of debt would go down, inflating the bond prices. The cap rates and the discount rates on real estate would be pulled down, and the valuations would be propped up. The valuations are not going up because the cash flows are growing because of demand. The valuations are being inflated through over-accommodative monetary policy, pushing interest rates to zero and negative. So it's not a numerator effect that's causing asset prices to go up. It's a denominator effect, driven by over-accommodative, unorthodox monetary policy. It's a perverse monetary policy situation. Okay? Never been done in history. So that's the impact on asset prices. What would be the impact on savers? I go to a bank, I deposit my money in a bank. There's people who listen to this stuff. Okay. I go deposit. Let me ask you a question. I go to a bank. All right. The bank's offering negative interest rates. Are you going to put your money in the bank? No. You're probably going to put it in a mattress. The negative interest rates is also indicative of disinflation, falling prices. So why would I pay the bank to put my money in the bank, to have them charge me to hold my money, when I could basically just put it in cash and hold it, in a mattress at my house?
You would do Swiss banks.
No, the Swiss are also charging people now.
Well, so that's what they're doing.
They're
right?
charging you, yeah,
And they
to
do
hold
it.
their money. And because a lot of these countries are now issuing bonds at negative interest rates, you're paying them to buy the bonds. So it turns finance on its head. We used to think that if we're going to lend money to somebody, they're going to pay us an interest rate. Now they're basically saying, no, finance is different. We as banks and we as central banks and treasuries are now going to charge you to buy these bonds, charge you to put money in these accounts. So you're worse off. So the savers, particularly pensioners, are totally housed. Right? Because you're putting money in these accounts, in these vehicles that are actually negative yielding. Your standards of living and social welfare are declining. Okay? It's perverse. Never happened before in history until over the last 10 years. What about investors? Will investors benefit from negative interest rate policy? Yes, because it's going to inflate their assets. Real estate, bonds, and stocks. So they're going to be better off. It'll eventually, in the short run, eventually it'll be a feedback loop, and things will deteriorate, and those bonds will probably, the corporate bonds will be defaulted on, maybe some of the sovereign bonds. The stocks will be driven down because earnings are going to start to go down. So there'll be a feedback loop at some point. It props it up in the short run, but in the structurally and secularly, it could have a negative impact on the system. What about businesses? Would it benefit businesses if their weighted average cost of capital is pulled down? Yeah, because that would increase the present value, the net present value, and internal rates of return on investments. So it'll prop them up in the short run. Eventually, the feedback loop, the lack of consumption, investment, slowing economy will eventually hit business earnings and will eventually hit stock prices at some point. So that's basically the.
So why in the long term is it bad for businesses?
Because because at some point in time, the economy is driven. You know, 3/4 of the economy is driven by consumption. So if I invest in bonds and I invest in these securities and I'm getting negative interest rates and I'm actually paying them to hold their paper, I don't have as much money as I did before, so I'm not going to consume and invest as much. And that's going to have a negative. I'm not buying, the G.I. Joe with a Kung Fu grip anymore. I don't have the money to do it. That's going to have an impact, on the economy at some point in time. Because people aren't going to have savings to rely on. They're not going to have savings to retire. Okay? And it will have an effect eventually. Okay, let's see the next one. How much time do we have?
5 minutes.
Using the Fisher equation, what variables drive the risk-free rates and nominal interest rates on treasury securities up and down? I think we already went through this. Inflation expectations. Right? Real rates of return plus inflation expectations give us nominal interest rates. If inflation expectations go up, nominal interest rates go up. If inflation expectations go down, nominal interest rates go down. Show the equation and the graphical representation for a normal upward sloping curve, a flat curve, and a inverted curve. Okay, so you got to show me that. So you already know the Fisher equation: I(n) equals R plus E. Here's your normal curve, right? This is the maturity on the bonds. This is the yield to maturity or the interest rates. The further you go out, the longer the maturity of the bond, the higher the interest rate, because you want to be compensated for the erosion and deterioration in your purchasing power due to the inflation. Okay? Now, that's a normal curve. So a flat curve looks like this. When the curve is flat, the inflation expectations are not positive, like a normal upward sloping curve. They're actually 0 in a flat curve. In an inverted curve, which is where we are right now, the yield curve is inverted the most it's ever been since 2007. Okay? And basically, the yield curve is the precursor to a recession. Okay? And it's been a very accurate predictor of recessions going back to the 1970s, post-World War II, and you can even go back 150 years. Did I show you the yield curve next to the S&P 500? Did I show you that dynamic yield curve? Did we go over that in class? Yep, exactly. So the inflation expectations under an inverted curve are negative. And this is the problem right now, is the economy is going into, the global economy is going into a recession. And investors are anticipating basically negative inflation or lower inflation, inflation expectations. So it's pulling down the long end of the curve and causing the short end of the curve, interest rates to be higher than the long end of the curve. The Federal Reserve controls the short end of the curve. And if the Fed doesn't start buying bonds, driving up bond prices and driving down interest rates to make the curve normal again, the stock market is going to peak in less than 12 months and we will be in a recession in less than 24. So where are we right now? The 2 and the 10-year Treasury yield is now inverted by almost 80 basis points, the most it's ever been since 2007. And the inverted curve happened maybe like a month ago, based on that measure. So last month, which was what, August, right, 2019, when is the recession going to hit? Yeah, August 2021. It's an extremely accurate predictor. Although a lot of the people out there right now are saying that things are totally different. The yield curve is not as predictive as it was before for recessions, therefore we shouldn't use this anymore. I think those people are very dumb.
Doesn't that go against you saying that we have to re-understand these models because we're in completely different conditions?
Yeah, and that's what they're saying. They're saying an inverted curve will not be indicative of a predicted recession. I don't believe it. Okay. What's interesting is that the yield curve in Japan was actually almost normal all the time, normally upward sloping, although the interest rates were really low. I mean, their curves look like this. Their curves look like this. So this is like negative at 10-year, and then they're negative here on the short end. Here's ours is normal, like this. Theirs is down here, like this. It's still normal, but again, the Japanese economy has seen normal upward sloping yield curves and has fallen into about 14 recessions over the last 25 years. So you can have a normal curve and still fall into a recession. But the United States is a little bit different. I really think the inverted curve is an extremely powerful predictor of recessions. And a lot of people believe it, and that's why the stock market dropped 800 points the day that it inverted, because they were all freaking out.
Is that why the people don't agree with the inverted curve as a signal of recession anymore? Since
Yeah, they're saying,
because of Japan, as an example?
well, no, because interest rates are like this. Yeah. This would be the normal inverted curve, maybe 10, 20, 30, 40, maybe 50 years ago. But because of over-accommodative monetary policy, our interest rates are already low, and they're saying that, hey, you know, they're already low, just because it inverted, it's no big deal. I don't believe that, because the bond market is basically forecasting global recessions. The globe's already in a recession, okay? And we'll get sucked down with it at some point.
Won't that just escalate our recession? Could it come faster?
Yeah, it could come faster. You know, and the trade war is doing that. Okay? And then, you know, as the trade war hits, a lot of these export-oriented economies will have less tax revenues to service the sovereign bonds. So if they get hit really hard, a lot of these emerging markets, because the trade flows have collapsed, because China's not buying as much anymore, and neither are we. What will happen is they won't have enough tax. You guys, hold on. They won't have enough tax revenues to service the interest on the bonds. They'll default on the bonds. That'll create a sovereign bond crisis, and that'll contage throughout the world and basically bring the whole world down. Drag it down. It's happened before. Investors right now are going further out on the curve. If you bought zero coupon bonds, long dated bonds, you made 30% return so far this year as of September. So that was the play, was long bond investing. That market's kind of playing out. I think this is the market right here. Because as the Fed steps in, starts buying the bonds and driving down bond prices, bond principal amounts, bond prices will go up on the short end. So this is the next thing that will happen.
So they're moving to security investments?
Yeah, they're going for long term, and they're going to, they're gonna start bringing this down to stimulate the economy. Trump wants the Fed to cut interest rates at least 4 or 5 times before the elections. But he doesn't want to do it.
Easy to.
So everybody thinks that the Fed may be, since they've inverted the curve, because they didn't lower interest rates quick enough here to keep it normal, that the Fed may be conducting monetary policy mistakes and not lowering interest rates fast enough to mitigate the global recession and the recession that we're basically looking at. Okay? So these are the debates. That's why I'm bringing this up, because it's all relevant. Okay? And then we'll get into more of this stuff and we'll go through this stuff. So on Tuesday, bring your problems. Those who didn't present. People on Thursday presented. If we didn't present their problems, just present it on Thursday. Let's work through this stuff. Let's get rid of it so we can start working on the project. Show me your portfolios. I'm going to walk around. I want to see your pre-tests. I want to see your memos. I want to see your resumes. I want to see your proxy portfolios. I want to see some production. Tuesday and Thursday, give me what you got. I'm into quality. The actual
Oh, really? Yeah. 25 stock reports?
My fear is that a lot of these bonds in the marketplace, the short term, when they start rolling in the environment, the bonds will be issued. And the government will love it because it's a tax. And unfortunately, it's permanent. That's our fear. Is that negative interest rate, negative yielding government bonds is now scheme, basically by sovereign bonds and second banks, to basically tax us and push the burden onto the public. Before there was, we're now being taxed to buy the debt. Not only do we have, we're going to be your grandkids and your great-great-grandkids and your grandkids, right? There's no more money. There's no money. So how do governments basically serve the debt, appropriations, military entitlements, and there's no more money? You get to issue more bonds. Issuing bonds to pay the interest on the bonds. It's like you borrowing money to pay back the student loans. Your debt doesn't go away.
It's like a little fun scheme.
Yeah, no, dude. What am I gonna do? I can use a job. I know. We're screwed. Wait, just below. Oh my god. Are you like, oh, I'm
All is fine. I'm like, it is.
So again, like, so many people, like, James, you, Shimon,
It's only going to benefit to investors.
I would just.
And then I also say, I'm actually like, trying to like,
太乱了，你知道吗？他那个思维都是不清楚。这里这些都不懂是什么。哦，这个没有，这个没有，这个有，有一些有，有一些有，但是EA我没有。你知道还有因为我的找到它 Excel， 还有那个就是看电影那个都写吗？这写了。还有那个 resume， 反正 resume 的话，如果怎么样那种，就是找工作的 resume， 我在其他都有写过，对，我也是。我以为是你的。对，就上那个上哪个老师？我忘了一个女的。对，是个女的，好像短头发的。然后有点老了，然后超级简单。他只给了我 A 奖。我跟你说两个。
thank you.
And she can help you too.
Yeah.
A lot of stuff.
If I think a random question just about
You gotta follow me.
about the market or anything like that over the weekend, do you prefer text or
Yeah.
email?